Tim Quast joining us now. He is the founder and CEO of Market Structure Edge. Tim joins us every week from a different location.
Does, man. He owns like 25 homes.
Where are you now?
This guy owns homes everywhere.
Bullish
and they're all
homes.
nice.
And if you use Market Structure Edge, you too can own 25 homes. There you
That's
go.
a great pitch right there. I get Market Structure Edge. I want to own 25 homes. I don't even own one home right now, I don't think. My other one's bulldozed and
Dennis might be homeless.
I guess I got a rental, but I'm going to be homeless pretty soon. You're going to have to come feed me on the street. All these stock tips I've given you over the years, you guys are going to have to like throw some money in my can, some Bitcoin in my can.
Come stay in one of mine, Dennis. You come stay in one of mine.
All right, I'm taking you up on that. I should do that right now. What's going on, Tim? What's up?
Well, it should be a very interesting week for fans of market structure, right? These are always fascinating weeks to me, where we kick off an earnings season, and we always begin with the big banks, which are, to me, Dennis, I don't know how you feel about this. I'm not a great fan of trading the banks, but there are occasionally opportunities in those. But then this always slams in a clash of titans fashion, one of the phrases I like to use, into options expirations, and it always gets short shrift. I think it's very important for traders to understand how those things work together. So we have options expiring Thursday and Friday, and then we spill into next week, and Monday a new series trades. Then the banks will true up their books related to the expiring options and the new options that begin trading on Tuesday. Then you have VIX expirations on Wednesday. We finally clear our way out of the turbulence Thursday or Friday. And the problem is that everybody thinks it relates to, Microsoft buying Nuance, which you were just talking about, or how the banks perform, or Delta Airlines, big company that's reporting results this week. And they misinterpret what the market is telling them. And I'm not saying that the market will surprise people, but I'm saying that there is a possibility of it, because you'll remember that we talked about how tech would outperform. Early in April, I said tech is going to be the place to be again, no matter how much you hear this discussion about the reopen trade and a shift back to value and the stocks that had done well. And there are always outliers and exceptions. Clearly, Zoom hasn't done well, but Microsoft sure has. Look how well Microsoft has done. And it comes back to the construction of the market and what the money does today. No matter how much you and I and all the pundits you can just see the edge of CNBC behind me there on the TV, how much the discussion is about people thinking about how some company is going to perform, that is the driver of the market. It's not. It was in 2000. It's not in 2021, because it's not what the money's doing. Money will allocate itself to assets. And we can see this, by the way, in the data, and it will periodically make shifts. So the question really is, for all of us, what should we expect as earnings begin and options expire? And we can go back to March just as a precursor, because I think it's very telling, not because of earnings, but because of what happened there. So you have this huge hedge fund blow up, Archegos Capital, and the significance of that isn't that Archegos lost $8 billion. It's that there were 6 big prime brokers involved in this, and all of those instruments reset the end of this week and next week. And what will their appetite for risk be? What will be the cost of leverage after an experience like that? Well, I would submit to you that the cost of leverage is going to go up, and the appetite for risk on the part of big banks is going to go down. And I think that those things could be harmful to the markets. I don't think it will happen right away, but I think that you get to about Tuesday, Wednesday next week, we could have a sudden rumble through the markets that people will attribute to an expectation that was overhyped for earnings, and it won't be that at all. And I'll show you a couple of things related to that.
Yeah, when you say those instruments reset, what do you mean?
So whether you use options or futures or there are all kinds of swap contracts from, you hear this discussion about total return swaps,
Yeah.
contracts for difference. These are all ways to try to pursue the economic return in different baskets of things without actually having to own them. So the bank will take the risk of having to go cover it, and a hedge fund will bet on the likelihood that they will get paid that economic return, and their risk is having to pay a fee or put up collateral, like Archegos did. Archegos put up its portfolio as collateral for a heavily leveraged bet. And then the bet failed, and they not only lost their collateral, right? It's like putting your house up to bet on Bitcoin, and you get a bunch of Bitcoin and you're holding it in an account, and then your Bitcoin is sold and you lose your house too. That's the equivalent here. And so that's what happened in March. So will banks want to take that kind of bet again? I don't think so. Not to the same degree.
So to summarize that point, you are expecting what in the next week and a half?
Oh, okay, great. And let's look at a couple of things to understand this. So I'm going to share my screen.
Sure.
And the traders, you can do this too. Just go to marketstructureedge.com. You can use this for free for 14 days. You don't need a credit card. And it's just a way to change your thinking about what drives the market. Dennis has talked about this for a long time, about the importance of the rules and how those rules affect the way things trade. So for instance, here, I've got Microsoft on the screen because you happen to be talking about them. People started to bet on a deal in Microsoft that Microsoft would pursue something right here. How do we know? Well, because short volume, that is the percentage of daily trading volume coming from borrowed stock, dropped to what we call our deal threshold level at about 30%. You can see that, traders.
Wait, hold on. Can you explain why would that indicate? Like, what is the deal threshold? Why would that indicate that?
Okay, so it's important to understand that about half of all market volume, 45% of it, comes from borrowed stock. When you see a bunch of volume out there, half of that volume isn't coming from owners meeting owners. It's people furnishing borrowed stock. Okay, so when that level drops near 30%, and we've seen this for 15 years in deal stocks, we're very, very good at tracking M&A arbitrage. And our analytics are used all the time by big public companies for that purpose. And here's what happens and why it's such a tell for deals. So when it drops to 30%, you can conclude two things. Number one, the cost to borrow that stock has risen. And machines that just go around the market scooping up cheap stuff to borrow and furnish to the market because they just want to intermediate the intraday volatility, which, by the way, in the S&P 500 is 300 basis points every day. People don't understand how much movement there is. So machines will intermediate that and go long and short based on how average prices are behaving. But when the cost rises, you get excluded from a basket. And if there are deal arbs walking around and talking to people who actually are thinking and who hold Microsoft, that those owners may not want to loan their securities out. So the levels decline. And we can look at what happened to Nuance as well. And we will see a move in that people didn't figure that out until about a week ago. But here for about 2 weeks, people thought Microsoft is going to do a big deal. So we want to be long Microsoft, not short Microsoft. And that whole attitude pervaded the market, and it showed up in this steep drop from the normal levels of shorting for Microsoft to a level that was very abnormally low and right at that 30% threshold.
So can you explain why would that indicate that a deal is imminent, though? I guess
because people want to keep their stock, right? They don't know which direction this goes, but generally deals in our era are good for stocks. If there is a battle, they may not necessarily be. And I can give you lots of cases in point to illustrate that feature of the markets today. But that's what it is. It says, we believe something is going to happen. So if we're owners of the stock, we want to be long. And people will bet that, okay, now let's go try to figure out who it might be. It really comes down to that. When it's It's a principle of the market that applies in more ways than one. Deal stocks diverge from norms, and passive money wants stocks that track benchmarks. So you begin when short volume drops or when behaviors begin to change in the marketplace, those things get excluded. But the big reason is owners don't want to lend out their securities. That's all you have to know. And you'll see it show up in short volume. Look at Nuance here. So Nuance was well over 50% short just back here at the end during month-end window dressing. This stock was 73% short. Then it imploded. It dropped from 73% short all the way down to 30. There is your deal threshold level. And so there was confirmation from the deal arbs that probably Nuance was the target. And that arrived on April 6th. So not very long ago, but long enough ago to tell you that all the deal arbs had shifted from short Nuance on its fundamentals to long Nuance on its M&A attributes. And there you go. And you will often see that. Now, I'm not telling you can go sift through all the data, but what you can do, if there's a rumor that develops, you can go look at the data. So let's go look at the short volume. And where did it change? And what are people doing around options expirations? And it's a definite tell. We were, now that it's public, I'll tell you that we supported Chevron in its acquisition of a company, Noble Energy, some time ago. And we looked at the data and we said, you're going to have competition in this deal. And because we could see it in the patterns. Active money would not buy the stock and short volume continued to decline. And son of a gun, along came Carl Icahn. He wanted a bone, and he's very good at it. He's very good at getting a bone out of a transaction, rather than that he will publicly resist it. But then once he receives something that he wants, then he will embrace that deal. But we could see it coming because of these very characteristics. And it often shows up this way. And traders, you can use that to your advantage. So there's a rumor, go put it in a portfolio at Market Structure Edge and look at it and see what happens. If you see a dramatic change in short volume like that, that's a pretty good tell that there's going to be some news coming.
When you're looking at, the sentiment on the top chart, is it really when it starts crossing over is when you start getting interesting from the long side, when you start seeing, because, when you're pointing these out, it's like, it seems like it's when sentiment crosses over, it's hanging out below the closing price. And then market structure sentiment seems to start to, drift higher and then starts crossing over. Is that where you're looking to strike, is usually on those crossovers?
There are three ways that we look at sentiment. And what Dennis is talking about, folks, is you have this line, the smoother line.
Yeah.
This is sentiment. It's a supply-demand measure. That's what it is. And then here's price. So we're just comparing supply and demand and the movement of prices. So you can see here price moved up because of short covering right there. Sentiment ticked up. Oftentimes, that's one of three. So there's the three ways that we look at sentiment are, does it tick up? Sometimes that works, sometimes it doesn't. That's about 30% right. Does it cross over 5? That is actually about 83% right. The challenge here was this was options expirations. This is where Archegos blew up, and it caused all kinds of trouble in the market. It caused people to abandon their strategies left and right, and we saw that show up in the data. And then the third way is to buy ones and then sell at mean reversion. So you buy an uptick, sell a downtick, or a combination of those. Buy when you cross over 5, because now sentiment is demand exceeds supply, because the axis is 5. So you want to generally own stuff that is above 5. Stuff that is at 5, like the banks, tend to reflect how the market moves. And we could look at J.P. Morgan or Goldman Sachs if you like. And then upticks and downticks. It's those three things that will give you 90% of the opportunity to catch short-term moves. And I think in terms of 5 to 7 days. That's it.
Let's look at Goldman Sachs, because they're going to report earnings on Wednesday. So kind of get the feel for the sentiment going into the report, and what the market thinks.
So here's Benzinga, April 12th. That's the name of the portfolio, and I'll look right across.
He's got the whole portfolio built right off of our earnings calendar. Nice.
There it is, right? So there's Goldman Sachs. It's a 5 and topped. It is mean reverted. Short volume is at 49%, but we want to go look at the trend. Trades $19,000 a trade. Very liquid stock. So now let's go look at the data here. And I like to back this up just a little bit so we can look at the longer term trend. Back it up to 3 months. Let's look at what sentiment has done. You can see that here it's not going to do as well as it did. This was the great time to buy Goldman Sachs when it ticked
zero
up.
or
Right.
one.
It's at 1 and it ticked up, and you stay in it all the way until it drops below 5. There's you would have captured all the gains. And now it's ticked back up, but it stopped. It topped at 5, telling us, and now go look at short volume, right at trend, but very close to 50%. Notice here again, this is where initially Goldman Sachs went long opposite Archegos. Then it shorted Archegos's position right there. So they knew by the time options expired that trade of Archegos's was going to blow up. But right now it tells us that this does not offer a lot of upside. I think Goldman Sachs will be up a little bit with results, but it tells us people have straddled it. That's what it tells us. If sentiment is 5.0 and short volume is half of the volume, that's a long short trade now. And the kind of gains that we saw from Goldman Sachs are not going to be there this time around. That's what the data are telling us. Now,
the easy money has been made.
The easy money has been made. All the bets on the reopen trade and maybe rising interest rates and therefore better returns on the books for Goldman Sachs, that is baked in and it's no longer there. That's what the data tell us. Now we can check that next Monday. But look back. What did we talk about? Tech would do well. That was correct, and it was based purely on these data.
You're not talking so much the numbers as much as you are the reaction to the numbers, right?
Exactly. The supposition, the numbers will probably be very good, but the supposition that those numbers drive the behavior of money in the market is where the logic breaks down. For that to be true, 80% of the money in the market would have to be following rational thought. Well, that has not been true since about 2001. Today, 9% of the volume comes from rational thought. So what this tells us is that passive money is no longer increasing its allocations to financials. That's not where the money's going. And so without that money, those stocks are not going to rise no matter how good their financial performance. So look, I think they could do fine and have a little uptick with results because they're right at the axis of 5. There's neither greater demand than supply nor the reverse of that. But it tells us that's not where the money's going. Not where the money's going. In fact, the whole market is topped heading into options expirations. If we look at, I could have just hit it. Let's just look at broad market sentiment. So this is a measure of that whole supply-demand waxing and waning feature that the market's got. Topped, markets decline. Topped, markets decline. This thing was weird because of the Archegos capital blow up, but it is not the thing to look at. See, the market actually fell before sentiment topped. Where are we now? We're topping again. So statistically, the likelihood that the market goes higher next week is very low. And the likelihood that it declines and then people improperly attribute it to, oh, we got overexcited about the reopen trade, the companies aren't performing as well. It will not be that. It will be the fact that passive money has already allocated its assets. And if it does not continue to do that, the market will decline. It's that simple.
All right, we'll have to find out. Tim Quast is the founder and CEO of Market Structure Edge. Joins us every Monday for Market Structure Mondays. Tim, always a pleasure. I look forward to your next house next week.
Have a
50
good
houses
week, you guys.
in 50 weeks. That's what we
That's the
want.
goal.
Tim, you got to buy some more houses.
That's right. I got to get to it. So if you'll excuse me,
All right.
I need to go buy a house.
Go on Zillow.